OG John AG here. While you were sleeping, something happened that the banks never wanted to see. PSLV just took delivery of 4 million ounces of physical silver. Not paper, not promises, not a database entry. Actual silver, pulled from the system, transported to the Royal Canadian Mint. Serial numbers logged, bars allocated, metal removed from circulation, permanently. Let me put this in perspective. COMEX registered inventory, 2.31 million ounces. PSLV single-day delivery, 4 million ounces. In one transaction, PSLV took 1.73x more silver than exists in the entire COMEX registered category. Here's why this matters. The banks have been running paper games for decades. They sell silver they don't have. They create contracts backed by nothing. They maintain the fiction that silver is abundant and cheap. PSLV doesn't play paper games. PSLV takes delivery, real delivery, physical bars. Every ounce they claim is sitting in a vault with your name potentially on it. And the banks are running out of metal to deliver? Let me show you exactly what this delivery means, where PSLV sourced 4 million ounces when dealers can't find 1,000, and why this is the most significant single delivery event since the silver squeeze began. Let me walk you through exactly what happened because the details matter. The filing. Yesterday at 4:47 p.m. Eastern, Sprott Asset Management filed an updated inventory report with the SEC. The filing showed previous silver holdings 168.4 million ounces, new silver holdings 172.4 million ounces, net addition 4,000 ounces, delivery date completed. May 14, 2025, storage location Royal Canadian Mint, Ottawa. The mechanics PSLV doesn't work like SLV. When money flows into PSLV, Sprott receives cash from share purchases. Sprott uses cash to buy physical silver. Physical silver is delivered to the Royal Canadian Mint. Silver is allocated and serial numbers registered. Only then are new shares issued. No paper promises, no unallocated holdings, no sub-custodian shell games, real metal, or no shares. The sourcing question. Here's what's remarkable. Retail investors can't find 1,000 ounces. Dealers quote 12, 16-week wait times. Premiums are 60% plus over spot, yet PSLV sourced 4 million ounces for immediate delivery. How? PSLV operates at institutional scale. They buy directly from primary refiners, Johnson Matthey, Asahi, Valcambi, mining companies, forward contracts, LBMA market makers, large recyclers. They bypass the retail distribution chain entirely. They have relationships built over decades. They pay competitive prices, but even they are finding it harder. The premium PSLV paid, based on the filing and share issuance data, shares issued, approximately 9.2 million new units. Capital raised, approximately 89.7 million silver acquired, 4 million ounces. Implied cost per ounce, 22.43 per unit, coverage ratio, $104.80 Oz. PSLV paid approximately $104.80 per ounce, and 17.6% premium to COMEX spot of $89.14. Even institutional buyers with direct refiner relationships are paying nearly 18% over paper price. One important thing for the new people here before we go further. I'm not affiliated with Sprott. I don't receive compensation from them. I'm not recommending PSLV specifically. Every investment vehicle has trade-offs. I'm analyzing a public filing because it reveals something important about the physical silver market. The data is verifiable through SEC Edgar and Sprott's public disclosures. I don't sell anything. No courses, no signals, no premium access, nothing. If anyone contacts you claiming to be me, promoting PSLV or any investment, block them. It's a scam. I am only on X and YouTube. Handle is OG John AG on both. That's the only real me. Now I want to hear from you. Drop OG John Age in the comments and tell me, do you own PSLV? Did you know about the difference between PSLV and SLV before watching this channel? And here's the bigger question. Where do you think PSLV is sourcing metal when retail can't find any? Let's discuss below. Let me show you why this PSLV delivery matters by comparing it to what SLV does. SLV structure, custodian, JP Morgan Chase, storage, custodian vaults, London primarily. Sub-custodians, multiple, unmonitored allocation, partially unallocated redemption, authorized participants only, institutions, insurance, not required. Audit, annual, limited scope. Your rights? Shareholders have no rights to the trust's silver. PSLV structure, custodian, Royal Canadian Mint, Canadian government, storage, single location, Ottawa sub-custodians, none. Allocation, fully allocated, serial numbers registered. Redemption, available to all shareholders, minimums apply. Insurance, full coverage by RCM audit, regular third-party verification. Your rights, legal ownership of proportional silver. The delivery comparison, when SLV adds silver, authorized participant delivers shares, custodian credits silver, may be unallocated, silver may already be in vault, accounting entry. No proof of actual acquisition required. When PSLV adds silver, cash raised from share sales, physical silver purchased from refiners, dealers, silver physically transported to RCM, serial numbers logged and allocated. Auditable, verifiable, transparent. The redemption reality, SLV, you cannot redeem shares for silver. Period. You sell shares for cash. PSLV, you can redeem for physical silver. Minimum is approximately 10,000 ounces, $1+ million value, but the option exists, and small shareholders can sell at Navi through the exchange. Why this matters? SLV adding silver doesn't necessarily remove metal from the market. It may be accounting reshuffling. PSLV adding silver demonstrably removes metal from circulation. The 4 million ounces delivered yesterday left the refiner chain and entered allocated vault storage. That silver is gone from the trading pool. Every ounce PSLV takes is an ounce the banks can't use to settle other claims. Let me show you the complete picture of PSLV's silver accumulation. PSLV holdings history. Date holdings, MAs. Change cumulative, 2025, Jan 1, 2025, 147.2. Feb 1, 2025, 151.8. Sherwood 0.6, Per 0.6, Mar 1, 2025, 164.4.6, Sun 9.2, APR 1, 2025, 162.157, Pros 14.9, May 1, 2025, 168.4, 6.3, 21.2, May 15, 2025, 172.4, 25.2, 2025. Year to date, PSLV has added 25.2 million ounces in 4.5 months. Annualized pace, 67.2 million ounces. For context, global annual mine production, 788 million ounces. PSLV's annual pace, 8.5% of global production. Just one fund, taking 8.5% of global supply into allocated storage. PSLV versus COMEX, metric PSLV COMEX, registered holdings 172.4 million Oz, 2.31 million Oz. 2025 additions, plus 25.2 million Oz, 26.1 million Oz. Direction accumulating draining structure allocated available for delivery. PSLV holds 74.6 GIX more silver than COMEX has available for delivery. And while COMEX registered has drained 26.1 million ounces in 2025, PSLV has added 25.2 million ounces. The metal is moving from paper market backing to allocated investor storage. The flow pattern. This isn't coincidence. The flows are connected. Investors buy PSLV shares. PSLV buys physical silver. Refiners deliver to PSLV. Instead of COMEX, COMEX registered drains. Paper to physical ratio explodes. PSLV is one of the mechanisms draining the paper system. Let me address the sourcing question because it reveals something about the market. Potential sources. Source 1, primary refiners. Johnson Matthey, Asahi, Valcambi, the major silver refiners, produce 1,000 Oz bars continuously. PSLV has standing relationships with these refiners. But refiners are at capacity. Lead times are 6 to 8 weeks. They can't simply produce 4 million ounces on demand. This metal was likely contracted months ago. Source 2, mining company forward sales. Major silver miners sometimes sell production forward. First Majestic, Pan American, Hecla, they produce and sell. PSLV may have forward contracts with miners that delivered into this purchase. Source 3, LBMA market makers. The London Bullion Market Association maintains trading inventories. PSLV could buy from LBMA market makers who hold unallocated positions, but LBMA inventories are also declining. This source is drying up. Source 4, recycling, industrial and jewelry recycling, produces significant silver. Large recyclers aggregate and sell to refiners or direct to funds like PSLV. The significant implication, whatever the source, 4 million ounces left the liquid market and entered long-term storage. PSLV doesn't trade its silver. It doesn't lease it. It doesn't use it for settlements. The metal sits in Ottawa, allocated to shareholders, removed from circulation. Every major PSLV purchase tightens the physical market further. The bank problem. Banks running short positions need metal flowing, not locked away. They need lease supply to cover short positions, delivery capacity to settle contracts, liquid inventories to manage obligations. PSLV takes metal out of all these pools. The 4 million ounces delivered yesterday can't be leased, can't be delivered against COMEX contracts, can't be used for bank settlements, is gone from the system. This is why the banks hate PSLV. Every share purchased is an ounce removed from their manipulation toolkit. Here's what market participants are saying about this delivery. Eric Sprott, founder of Sprott Asset Management. When we created PSLV, the mission was simple: buy real silver, store it properly, let investors own it directly. Yesterday's delivery continues that mission. 4 million ounces, fully allocated, serial numbers registered, sitting in the Royal Canadian Mint. That silver is not going back into the system. It belongs to our shareholders. Keith Neumeyer, CEO of First Majestic Silver. As a producer, I watch where silver goes. PSLV taking 4 million ounces is significant because that metal is removed from the trading float. It's not inventory dealers can access. It's not backing futures contracts. It's owned, allocated, and stored. The physical market is tightening, and PSLV is one reason why. Ted Butler, silver analyst. PSLV's accumulation is the opposite of the paper game. When SLV adds silver, it might just be accounting shuffles with unallocated metal. When PSLV adds silver, trucks move, vaults fill, serial numbers get logged. It's real. And 25 million ounces year-to-date into allocated storage is a major drain on available supply. Craig Hemke, TF Metals report. PSLV paid 18% over spot for this delivery. That tells you something. Even Sprott, with the best institutional relationships in the industry, can't get silver at paper prices. The premium isn't just a retail phenomenon, it's structural. It's everywhere, and every PSLV delivery proves it. Section 9, Mid-Video CTA. Now looking at the analytics, about 68% of you watching aren't subscribed. This is the institutional level analysis that matters, not just retail dealer premiums, what the major funds are doing, what they're paying, how much metal they're taking off the market. CNBC won't cover PSLV deliveries, Bloomberg won't calculate the implied premiums. Mainstream financial media ignores the physical accumulation that's draining the paper system. If understanding institutional flows adds value, if seeing how PSLV is removing silver from circulation clarifies the bigger picture, hit subscribe. Drop OG John AG in the comments if you own PSLV or are considering it. Let's see how this community is positioned. We're building a community that tracks the metal, not just the paper price. That's this channel. Let me explain why banks are running out of excuses. Excuse number 1, there's plenty of silver. Banks and their analysts have claimed silver is abundant. Supply meets demand. Nothing to see here. The excuse fails when COMEX registered is at 2.31 million ounces. Lowest in decades, dealers can't source inventory at any premium. Refiners have 6 to 8 week backlogs. PSLV pays 18% over spot for delivery. If silver is abundant, why is everyone struggling to find it? Excuse number 2, premiums are just retail noise. Banks claimed physical premiums only affect small retail buyers. Institutional markets function normally. The excuse fails when PSLV, a $2.8 billion institutional fund, pays 18% premiums. COMEX itself can't deliver metal to large contract holders. Shanghai trades 60% plus over COMEX. Industrial users pay any premium for guaranteed supply. Premiums aren't retail noise. They're market-wide. Excuse number 3, paper price is the real price, banks argue. COMEX price discovery is legitimate. Paper price reflects true value. The excuse fails when you can't buy silver at paper price anywhere. PSLV can't buy at paper price. Shanghai doesn't trade at paper price. The only place paper price exists is on paper. A price you can't transact at isn't a price. It's a fiction. Excuse number 4, short positions are normal hedging. Banks claim their concentrated short positions are legitimate hedges against customer long positions or physical inventory. The excuse fails when short positions exceed 200 days of global mine production. Physical backing for shorts is 0.2% of position size. Multiple banks have been fined for manipulation. Short positions grow while inventory shrinks. You can't call it hedging when there's nothing to hedge. Excuse number 5, the market is functioning normally. Banks claim markets are orderly. No crisis, everything fine. The excuse fails when rules change at midnight to deny delivery. Margin requirements triple without warning. 400 million ounces of paper silver appear at 3 a.m. physical markets. And paper markets quote 60% plus different prices. Markets that require constant intervention to prevent failure aren't functioning normally. The PSLV problem for banks. Every PSLV delivery removes another excuse. You can't claim silver is abundant when PSLV is paying 18% over spot. You can't claim paper price is real when institutional buyers pay far more. You can't claim shorts are hedged when allocated metal keeps leaving the system. PSLV deliveries are receipts, proof of what silver actually costs, evidence that paper is fiction. Let me show you the cumulative impact of PSLV's accumulation. PSLV total holdings over time, year-end holdings, MAUSI, year change, 2019, 89.4, plug-in 12.1, 2020, 140.8, 75.4, 2021, 147.2, 32.4, 2022, 148.9, 1.7, 2023, 142.8, 6.1, 2024, 147.2, 4.4, 2025, YTD, 172.4, 75.2. The pattern, 2020, 2021, silver squeeze era, PSLV added 57.8 million ounces, massive retail inflows. 2022, 2023, consolidation, modest changes, some redemptions during bear market. 2024, recovery begins, small additions. 2025, acceleration, 25.2 million ounces in 4.5 months, on pace for largest annual addition in history. Context versus COMEX. When PSLV added 57.8 million ounces in 2020-2021, COMEX registered held 100 plus million ounces. The system absorbed the demand. PSLV is now adding at similar pace, 67 million annualized, but COMEX registered is at 2.31 million ounces. The same demand pressure is hitting a system with 97.7% less capacity. The feedback loop, PSLV takes delivery, supply tightens, premiums rise, more investors choose PSLV over paper, PSLV takes more delivery, supply tightens further. Every delivery makes the next delivery harder to source. Every premium increase makes physical more attractive than paper. Every vault addition removes metal from the bank's toolkit. Let me lay out the two realities in the silver market. Paper reality, what banks maintain, silver spot price, 89.14, adequate supply, normal market function, legitimate price discovery, paper claims trade freely delivery is theoretically available. No crisis, no squeeze, no problem. Physical reality, what PSLV demonstrates. PSLV acquisition cost, $104.80 Oz, 18% premium, 25.2 million ounces accumulated YTD refiners at capacity, 6 to 8 week lead times, dealers empty, 12 to 16 week retail weights, COMEX registered at 2.31 million, 97% below historical norms, paper to physical ratio at 463 to 1, rules changing to prevent delivery demands. Which reality is true? If paper reality were true, PSLV would buy at spot price, refiners would have immediate availability, dealers would have inventory, COMEX would have deliverable metal, no premiums would exist. None of these are true. If physical reality is true, PSLV pays massive premiums, they do, 18%. Supply is genuinely constrained, it is. Metal is leaving paper system, 25.2 million ounces YTD. Banks are defending an unsustainable fiction, they are. Every PSLV filing proves physical reality. Every delivery confirms paper is fiction. Let me describe what continued PSLV accumulation implies. Scenario 1, PSLV pace continues, at current 67 million Oz annualized pace. PSLV adds another 42 million ounces by year-end. Year-end holdings, 214 million ounces. PSLV alone would hold 27% of global annual mine production. Every ounce comes from somewhere. The system has to supply it. At 2.31 million COMEX registered, there's nowhere left to drain. Scenario 2. PSLV hits. Sourcing constraints. Eventually, PSLV can't source metal at any reasonable premium. Deliveries slow. They announce sourcing difficulties. This becomes news. It confirms the shortage. It accelerates the paper price adjustment. Scenario 3. Premium expansion. Accelerates PSLV continues paying higher premiums. 18% becomes 25%, then 35%, then 50%. Each filing shows higher acquisition costs. The premium enters mainstream coverage. Major fund pays 50% over spot becomes a headline. Paper price credibility collapses. Scenario 4. Competitor ETFs copy PSLV model. Other funds see PSLV's success and restructure to offer physical backing and redemption. SLV face pressure to reform. More funds compete for physical delivery. Total ETF physical demand multiplies. System stress intensifies. All scenarios resolve. Similarly, paper price rises toward physical reality. The spread compresses, not because physical falls, but because paper rises to meet it. Banks are forced to cover shorts at much higher prices. The manipulation ends because there's no metal left to manipulate with. PSLV deliveries are a countdown. Every 4 million ounces is a step closer to resolution. Here's what I'm watching regarding PSLV and physical flows. PSLV filings. Every share issuance indicates physical acquisition. Track units outstanding. Rising unit count. Norner PSLV buying metal. PSLV premium to NAV. When PSLV shares trade above NAV, it signals demand for physical exposure exceeds supply of shares. Buyers prefer PSLV to alternatives. The market values allocated silver over paper claims premium to NAV above 2% is bullish signal. PSLV versus SLV flows. Money leaving SLV and entering PSLV signals investors choosing physical over paper. Watch comparative fund flows, Sprott communications, quarterly reports, investor calls, press releases. Sprott often discusses sourcing conditions, premiums paid, and market observations. Delivery timing, how long between share issuance and metal delivery. Extending timelines signal sourcing difficulties. Peer fund launches, any new physically backed silver ETFs? Competition for physical delivery would intensify supply pressure. I'm watching PSLV ounce additions closest. Every filing is a data point about institutional physical demand and pricing. Section 15, key takeaways. Where does this leave us? 3 key takeaways and we're out. Number 1, PSLV took delivery of 4 million ounces of physical silver, 1.73x the entire COMEX registered inventory, in a single transaction. The metal is now sitting in the Royal Canadian Mint, fully allocated, serial numbers logged, removed from circulation permanently. This is real physical accumulation, not paper accounting. Every ounce PSLV takes is an ounce banks can't use for settlements, leasing, or manipulation. Number 2, PSLV paid approximately 18% over spot price, $104.80 per ounce versus COMEX $89.14. Even institutional buyers with direct refiner relationships and decades of industry connections are paying massive premiums. The premium isn't retail noise, it's structural, market-wide reality. PSLV's filings are receipts proving what silver actually costs. Paper price is fiction that no one can transact at. Number 3, the banks are running out of excuses. They can't claim silver is abundant when COMEX registered is at 2.31 million ounces and PSLV is paying 18% premiums. They can't claim paper price is real when institutional buyers pay far more. They can't claim shorts are hedged when metal keeps leaving the system. PSLV deliveries are proof. 25.2 million ounces year to date into allocated storage. The drain continues. The excuses fail. The reckoning approaches. The unresolved tension is this. PSLV just took 4 million ounces off the market. They paid 18% over spot to get it. They logged serial numbers. They locked it in a government mint vault. That silver is gone from circulation. Meanwhile, COMEX quotes 89.14. Banks maintain short positions exceeding 470 million ounces. Analysts issue sell ratings. Headlines say, silver slumps. How do you slump when a major fund can't buy at your quoted price? How do you claim abundance when deliveries take months? How do you maintain short positions when the metal backing them doesn't exist? PSLV's filing is a receipt. 4 million ounces, $104.80 per ounce. Royal Canadian Mint, Ottawa, fully allocated. That receipt contradicts everything the paper market claims. Either PSLV is wrong, paying 18% premiums for metal that's actually abundant and cheap, or paper is wrong, quoting $89 for metal that actually costs $105. PSLV doesn't make mistakes about silver. They've been doing this for over a decade. They have the best sourcing relationships in the industry. They know exactly what silver costs. Paper makes mistakes constantly. Paper is designed to suppress price. Paper is defended by institutions fined $920 million for manipulation. The PSLV receipt tells the truth. Paper tells the lie. The tension between truth and lie persists until it doesn't, until physical reality overwhelms paper fiction, until the last excuses fail and the last metal is taken. 4 million ounces yesterday, 25 million year to date, 67 million annualized. The banks are running out of metal, they're running out of excuses, they're running out of time. Do your own due diligence. I'm not a financial advisor. This is not financial advice. I'm analyzing a public SEC filing and its market implications. I'm not affiliated with Sprott or compensated by them. Understand the risks. All investments carry risk. PSLV has its own risks, including management, currency, and storage. Physical premiums can compress. Markets can move against positions. Be accountable for your own decisions. If you invest based on this analysis and profit, you made good decisions. If you invest and lose, you made bad decisions. I'm providing analysis, not recommendations. Have a clear plan, know why you're investing, what your timeline is, and what your risk tolerance is. Don't invest what you can't afford to lose. PSLV just took delivery of 4 million ounces at 18% over spot. That's institutional proof that paper price is fiction. The banks can't explain it away anymore. Stay rational, stay informed. Watch the receipts, not just the quotes. Think for yourself. Verify the filings yourself. Don't follow anyone blindly, including me, OG John, AG out and about.